Okay, so picture this. You're a foreign investor eyeing the Middle East, and you hear this wild fact about Kuwait. There's literally no personal income tax, and right now, absolutely no VAT either. Sounds like a total dream, right? Maybe even a tax haven? But hold on. When we start looking at the corporate side of things, wow. Doing business under Kuwait tax law suddenly requires a highly precise map if you want to navigate it successfully. So in today's explainer, we're going to be exactly that, your map and your compass.
All right, let's dive right in. Here's our agenda for today's journey. Number 1, understanding corporate income tax. Number 2, the 5% retention rule. Number 3, Zakat, KFS, and NLST. Number 4, registration and tax compliance. And finally, number 5, proposed business profits tax.
Let's start with Section 1, Understanding Corporate Income Tax. So, if you're operating as a foreign entity in Kuwait, your entire foundation rests on one magic number, 15%. Under the amended law number 2 of 2008, there's an annual income tax slapped on foreign corporate bodies doing trade or business in the state of Kuwait. And honestly, it really doesn't matter if you're operating directly or just going through an agent. Your net taxable income is getting hit with a flat 15% corporate income tax. No way around it.
And this brilliantly illustrates the strict contrast in the current Kuwait tax law system. It's essentially a system heavily targeted at foreign ownership. On one hand, foreign corporate bodies are fully taxable. But on the other hand, companies incorporated in Kuwait or other GCC countries like Bahrain, Oman, Qatar, Saudi Arabia, and the UAE, well, as long as they are wholly owned by GCC citizens, they are currently totally exempt from this 15% tax. Now, if a GCC company has some foreign ownership, they are taxed, but only on the portion of that foreign ownership.
But hey, there is a pretty notable safe harbor here. Even if you're a taxable foreign entity, if you're earning capital gains or dividends directly or maybe through investment portfolios on the Kuwait Stock Exchange, you can breathe easy. Those specific profits are safely exempt from the 15% tax. So that's a really nice little win. Moving on to Section 2, the 5% retention rule. I literally cannot stress this enough, you guys. This is the ultimate operational pitfall for foreign contractors. Seriously, treat this as the big gotcha of Kuwait tax law. Think about your day-to-day operations for a second and ask yourself, what actually happens when you pay a subcontractor? I mean, in most places, you just process the invoice and fire off the funds, right? But in Kuwait, oh man, if you just pay out the full amount without thinking about tax retention, it's going to severely impact your own bottom line. Here's the deal. By law, specifically Article 37 of Law Number 2 of 2008, every single entity is required to hold back or retain 5% of the contract price from every payment made to a contractor or subcontractor. Basically, this acts like a strict security deposit for the Kuwaiti government, just to make sure tax compliance is happening all the way down the supply chain. And if you forget to withhold this 5%, the tax administration will actually disallow your payments to those subcontractors as a deductible cost when they calculate your tax. So what does this mean in real life? It means those retained funds are completely frozen. You have to hold on to that cash until the vendor officially hands over a tax clearance certificate or a no objection letter, an NOL, from the Kuwait Tax Authority, basically proving they've settled their own tax bill. Why does this matter? Well, if you don't comply, you are personally on the hook for your subcontractor's taxes. Yikes. So yeah, this is easily the most vital everyday rule you've got to drill into your accounting department. Let's move to Section 3, Zakat, KFS, and NLST. Okay, now that we've tackled the heavy lifting of the main corporate tax and those tricky retention rules, let's take a super quick tour of the local landmarks to see how these build out the broader regulatory picture. First up is Zakat. This is computed at 1% of net profit, and it's paid by Kuwaiti shareholding and non-Kuwaiti GCC companies. Next is KFAS, which stands for the Kuwaiti Foundation for the Advancement of Sciences. That's a 1% contribution paid by closed and listed Kuwaiti shareholding companies. And finally, the NLST, or National Labor Support Tax. That's a 2.5% levy, and it applies exclusively to companies listed on the Kuwait Stock Exchange. All right, after all those specific corporate levies, let's take a collective sigh of relief. If you're a multinational business owner, or maybe you're bringing in expat talent, here is exactly what you do not have to worry about. As we touched on right at the start, there's absolutely zero personal income tax. There's also no VAT currently implemented, though, it is under study across the wider GCC. And crucially, there are zero Social Security contributions required for your expat workers. Pretty great, right? All right, Section 4, Registration and Tax Compliance. Let's shift gears to the practical how-to phase of our map, Knowing the rates is one thing, but walking the strict path to actually stay compliant, that's a whole different ballgame. And the timeline here is completely mandatory and it moves fast. Step 1. The literal second you sign a business contract or kick off operations in Kuwait, a clock starts ticking. Step 2. You now have exactly 30 days to register with the tax administration. No exceptions, and during this process, for Step 3, you'll have to select your first fiscal period. The good news is the tax authority lets this be anywhere from 7 to a maximum of 18 months, which gives you a little bit of flexibility to sync it up with your global accounting year-end. Now, to ground this in reality, this is what the Ministry of Finance's digital registration portal actually looks like for a new registration request. It's surprisingly straightforward. You just plug in your company details, upload copies of your contracts, your articles of association, maybe some agency agreements, and boom, you secure your tax card. And once you're officially registered and up and running, you'll be happy to know that Kuwait Tax Law does allow for standard commercial accounting deductions. Your taxable income is only calculated after deducting the allowable expenses you incurred to make that money. We're talking salaries, end-of-service indemnities, fixed-rate asset depreciation, and even an allowance for your head office administrative overhead. So, it's not all bad news. Finally, Section 5, Proposed Business Profits Tax. Okay, so everything we've talked about up to this point, that's the law of the land today. But if we pull out our telescope and look at the horizon, there are some major proposed 2024 laws that threaten to totally shift this landscape. The new Business Profits Tax Law draft wants to drastically expand who actually gets taxed. Instead of just singling out foreign entities, it expands the base to include resident legal persons and natural persons doing business. Now, it does keep the standard 15% tax rate, but here's the kicker. It introduces a formal 5% withholding tax on gross payments sourced from Kuwait to non-residents. So think royalties, interest, and services. It does throw us a small bone, though, by exempting businesses with a turnover under 1.5 million Kuwaiti dinars. Which really brings us to our final and honestly most provocative question of this explainer. How will this sweeping expansion of the tax base alter Kuwait's appeal to foreign investors? I mean, we're looking at a potential shift from a highly targeted foreign tax to a much broader modern corporate tax system. It is a monumental shift, and anyone doing business in the region absolutely needs to watch the space. Well, I really hope this explainer gave you a clear map of Kuwait tax law today and the compass to navigate wherever it might be heading tomorrow. Thanks so much for tuning in and keep learning.